Hi, welcome. I am going to go over the year 3 results of the Zoom simulation for our class. So the first thing I'm going to do is look at what's called a leaderboard. And this is something that shows us how everyone did, not in graphs, but in numbers. So on the leaderboard, this team had the highest points for the round. Now, one reason they had high points is I think it's one of the teams that forgot to finish their last round, and they were forced forward. So it means that their year-over-year results are going to look better than normal because last year they didn't perform as well because of a missed year. So of course they're going to, that's the great thing about the simulation is if you do miss a year, you do get not all but some of the points back the following year because it's a year-over-year improvement. Now, anybody that earned over 400 points in this round, and we had a majority of teams that did earn over 400 points, did very well. Because as the simulation progresses and companies become more efficient and competition becomes more tight, it's harder and harder to beat the competition, harder and harder to make more and more points. So anybody over 400 points did very well. And you can see here on this percentile rank, this ranks you against everybody else that's done the simulation in the past year. So if you are scoring a 90 percentile means you perform better than 90% of the people who played the simulation in the past year. So even if you're down here, these are all around in the 300 range, you're about 40 to 50%. So you're sort of below average in performance. And that's kind of how one way you can look at your performance on the simulation. Now, if you look at gross profit margin, here's another important area. Remember, everybody started out at 40%. And I had sent emails and made videos and reinforced the fact that you have to increase profit margins round after round. So by going into the fourth round, you should be in the 50 percentile or higher profit margins. And only about a third of our class is there. Everybody else is still in the 40 percentile, but the high 40 percentile gross profit margins, which is still okay. But you should be climbing into the 50s in round 4, at least in the 50s, if not the 60 percentile area. And some teams are below 40%. We have 4 teams below 40%, which is saying that in 3 years, you haven't really improved over the previous management, which was terrible, who had 40% profit margins. You've done nothing to improve that. You've made them worse. So if you're not doing well, it's because your profit margins are too low. What makes profit margin low? Well, low prices on the products that you sell is going to make low profit margins, and high costs. So if you have high costs and low prices, that's a recipe for declining profit margins. So you're going to have to, everybody needs to focus on increasing their prices if they can, and decreasing the cost of their car. And like I've said in, again, emails and videos, you need to be investing in operational investments to get those lower costs. Okay, so if we look at stock price, now here's a little hint on stock price. One way to make your stock price increase is to buy back stock on the finance page. Buying back stock on the finance page will help you to reduce the amount of outstanding shares, which makes all your per share statistics, including earnings per share, look better. And we have one company here, JR Auto, that's done better than 96% of all the teams that played the simulation, I'm told, in the past year, which is over 5,000 teams. So if you're over the 75% mark, you're doing exceptionally well in your stock price compared to the rest of the simulation. Now, the companies more towards the bottom, you may have issued a lot of stock. If you issued a lot of stock to raise funds in the early years, it's okay, but you should start buying that stock back now to reduce your outstanding shares. Also, if you have low profit margins and low earnings per share, that's going to affect your stock price. All right. Return on equity. Now, return on equity is a return on the equity of the company. So the larger the equity of the company, sometimes the harder it is to get a return because it's profits divided by equity, which is basically your stock value. And your stock value is your stock price times your outstanding shares. So here, it's difficult to increase this because a lot of times as your company grows, the equity grows. So the profits have to increase faster than the equity. That's how you get this to increase. So if you could increase your profits at a faster rate, at a faster amount, a bigger amount than the increase in your equity, then you're going to get, a better return on equity. Sometimes you can perform very well and do everything right, but you may lose some points here if your equity grows because your stock price went up very fast. Okay, total points. Now remember, for the simulation, let's see here. Just jumping over to the class. So, okay. Looks like round 4 is due on January 16th, which is tomorrow night. And you need over 2,500 points to earn the full 15 points of this assignment. So many teams, now this is only after 3 rounds, are more than halfway there. So most teams here are at 1,500. Most teams are at 1,500 or above, meaning that you have 3 more rounds to make 1,000 points. So 330 points a round isn't that difficult a thing to do. So most people look like they're going to get a full A on this project. Some of the teams that are lagging behind have under 1,500 points. We have about 10 or so teams in that area. You're lagging behind. So you really need to step it up. Read the student user guide, try more practice rounds, listen to my videos, look at the industry results to see what your other teammates are doing and why they're advancing and you're not. A lot more effort. You may have to put more effort in at this point to make sure that you can catch up, because a lot of the class are performing much better, and it's a tight competition. The performance of this class is performing very high compared to the rest of the classes who took the simulation when I'm looking at the percentile ranks. Okay, so operating profits here again. You want these to increase. One of the things that steals a lot of money out of operating profits is advertising and interest. So if you borrowed a lot of money and you have a lot of interest outstanding on that money that you're paying, you may want to start paying down the debt on the finance page by retiring it. Also, you want to make sure you're not over advertising. If you're over advertising, spending way too much in advertising, that's going to dramatically inflate your operating profit margin. It's going to inflate the costs and lower your operating profit margin. So you want to make sure that your advertising is kept in check. And I just want to correct something. The interest, is not part of operational. The interest comes out of the net. So the operational does not include interest. It's really the advertising is what you have to watch here. Overspending in advertising can easily drain a lot of your operating profits. Okay. Earnings per share is simply the net profits you made divided by outstanding earnings. So you could either make more profits and or reduce your amount of outstanding shares, which is easy to do on the finance page. You just retire stock, and that will reduce your outstanding shares. Okay, and companies here are performing very well in this area as well. You see the top end companies have about $10 and higher of earnings per share, and the lower end companies are half that. So you're performing at half the profit rate. And this is a reason investors are upset with you and they're not driving your stock up as much. You're not earning as many points from your overview because you're falling behind. Okay, ROA, return on assets. Now here, this return on assets is looking at profits divided by assets. So if you can increase your profits faster than you're increasing your assets, you're going to be increasing this percentile. Now it's difficult because we're taking on a lot of additional assets, and there's some rounds where you may take on a lot of additional assets in the form of operational investments or new plants, or leftover inventory. So if your assets grow faster than your profits, this percentile or your return on assets will go down. And some rounds you can't help that. But by and large, if you're efficient, meaning your capacity is efficient in your operating page, you're not buying more plants than you need, and you're generating significant profits with your sales, you should be able to get this to increase. Okay, so the net profit margin here, basically the big thing that comes out of here from operational, I would say would be the interest expense. So reducing the amount of interest expense you have will certainly help improve your net profit margins. Okay. Sales per share, this is just your sales divided by your outstanding shares. Again, you buy back stock, this will go up, increase your sales. This will also go up and help your score. Okay, so let's look at total asset turnover. Now, total asset turnover is looking at revenues divided by total assets. So again, here you want to increase your revenues faster than you increase your total assets. So this is a difficult one to always stay on top of, because if you are buying assets, meaning making inventory, buying additional plants, operational investments, your assets can grow rather quickly with this in a simulation because it's an asset-driven manufacturing company. So your assets in some rounds can go up, 25, 30%, 50%. And if your sales don't go up just as fast, you'll see your total asset turnover reduce. And it's really looking at how you take your assets and turn them into sales. So, for example, if you're going to open an ice cream shop and you just had freezers where you put your ice cream in freezers or display freezers, and when people would come in, you scoop the ice cream out of these refrigerators. Your total assets for these refrigerators may be $10,000, and your store generates $100,000 in revenue. So that's a great total asset turnover. On the other hand, maybe you're a Red Mango and you invest in $200,000 worth of soft serve machines. So these soft serve machines are very expensive, especially when you have multiple ones in the store. And if you have the same $100,000 in sales, you're going to have a much lower total asset turnover because your assets are so great. That's why you see a lot of these, you may see a lot of these frozen yogurt places closing because they had, one, it was sort of a fad. Two, they had a terrific amount of assets and debt they had to take on to open a store with all their soft serve machinery. And three, the sales weren't big enough to support the assets. The total asset turnover was too low in these stores, and they weren't, in addition to not generating enough profits to cover the cost of the store, the assets were too heavy, which is bad for people who open these stores. You put a lot of money down in investing where you might take a store like Ralph Rotten's, which just scoops ices out of refrigerators and is closed half the year, but yet they remain open because they have a much more efficient asset base. Okay, so that's looking at those. So these are good things to kind of look at. Again, make sure you're keeping up on your marketing charts. Where is your marketing per each vehicle compared to everybody else? So if you're underselling, if your sales are lower than everybody else, marketing may be your problem. On the other side, if you are underperforming in profits and operational profits, over-advertising may be your problem. You may have over-advertised. So you want to make sure that you have the most efficient level of advertising. You can see there's been a change going on here in the advertising. Resize this a bit. You can see some teams are changing their strategy, and we're back and forth as teams have been analyzing their advertising and adjusting them. Some teams have been going lower to realizing they're overspending. Some teams are going higher, and it depends on your strategy. Maybe you have a strategy where you advertise heavily because your cars don't meet the customer's expectation as well as other people's cars. Maybe some people have really well-built cars, but they have a smaller advertising budget because they let the features and functionality of the car help sell it. So there are different strategies that you can employ here, but you have to really get in here and look at what you're doing. Okay. So, and you can also analyze the sales charts. How are your sales for each vehicle compared to everybody else? So this is a good chart to see, okay, so one company was able to sell about 3,500 vehicles in this round. And some companies sold much less. Why is that? You should look into it. Did you under forecast, under manufacture? Did you under advertise? So there's questions and analysis that has to be done after each round. So actually we have here, this is someone even higher. Same thing for the sedan. The question would be 3,400 versus almost 5,000. What's the difference? What's the difference? How did this company investigate? How is this company able to build cars that sold so much more than yours? Was it that they forecasted higher and they built enough cars? Did they advertise more? Is their cars built better? These are questions that, a tight analysis can answer. Okay, now let's go to the industry charts. And we're up to round 3. So we could see here under the net profits. So you see how the net profits are growing. So we've moved up, and still this JR company still has a great strategy. They're dynamic. They keep moving ahead. They keep twisting and turning their strategy to avoid copycat competitors who look to what they did last round. They're constantly innovating and moving ahead. And they started with only $63 million in profits. Now they're up to $139 million in profits. Now everybody else is, the average last round was probably around 70 million. And I think the average this round is closer to 90 million. So everybody was able to increase their profits. This is not a surprise though, because the industry, these cars are growing at 20, 25% levels. Of course, you're going to expect your profits to go up. If your profits didn't go up, that would be a problem. Okay, if you look at points, here again we had a company that probably was forced forward or had problems actually wasn't forced forward. Had problems in the first round, recovered in the second round, and now is performing, I guess, within the pack in the third round. And again, here's a team here that this team, I'm pretty sure, they missed the round, so they were forced forward, but they were able to recover, making a significant amount of changes to get back into the race. Now, we went over points before in the leaderboard. You have to just kind of see, we have 3 rounds left, 3 opportunities to get to your goal of 2,500 points. Now, so you can kind of figure out how many points you need per round. And for some people, it's not very much at all. But you still want to remain competitive. Okay, so J&R has the highest stock price. Makes sense. They have the highest earnings. And we see the sales we had a much change between year 2 to year 3, and I think we have Zoom Motors is the highest in sales, but they're not necessarily the highest in profits. Because, listen, I give this example to students all the time. They always get this question right. I said, what would you rather have, a $400 billion company or a $100 million company? So everybody says, oh, a $400 billion company. And I tell them, okay, your $400 billion company is the post office, and it loses $500 billion a year. And the $100 million company is a software company, and it makes $50 million a year in profits. Now, which company would you rather have? So it's not always all about sales. It's about profits, maximizing shareholders' wealth, which J&R Auto has done consistently. Other teams, we have 2 other teams here that are doing very well, Continental and Ace Line, and then everybody else sort of in the middle here, some more towards the top end, and some people, if you're at the bottom end of this earnings per share, you need to get your earnings up. Okay. All right, so that's my review of round 3. Now, every bit of advice I've given to you 3 times already. I've said you have to increase your profit margins, you have to reduce your costs, increase your prices where you can. I know you can't always everybody can't sell their car at the top price all the time, but you have to be putting the time in to really evaluate how you're doing. So in a demo, I'm just going to go into my demo game. The first thing you need to do is review your year-over-year overview points. Where are you making points? So here I was able to increase my gross profit margin to 57%, and my operational and my net, and I was able to increase just about all my numbers, except I had a deficit, which was I got a little overboard on the forecasting last round. I can check out my assessment here and take some hints about my cash management. Unsold vehicles, the end of round can lead to unexpected deficits. Yep, that's what happened. And you forecast too aggressively. Okay, great. So there's some great tips here. I can go to charts, which we kind of just went over. But again, for the 4th time, always check your performance charts at the bottom to see your sales. So here my forecasting goods, except for economy, I could have sold 500 more vehicles than I forecasted. All right. And then the industry report, another important report to go to see, okay, what did the other competitors do? How did they make their car? It tells you exactly how they built their car, their profit margin, their cost reductions. Are you falling behind on your cost reductions compared to other people? Don't be cheap and cut out your cost reductions. If you don't buy operational investments on the production page, you're going to fall behind other companies. So here you really need to figure out what the other competitors are doing and build a better strategy, and then it starts over. So now I have higher cost reductions than I did before, but again, the customers' expectations are now gotten higher. These damn customers want more and more every year. And this is true in the real auto world. That's how companies compete. They get an idea of what customers want and they try to meet it. And every year they try to build a better car. And sometimes what you probably should do before you do anything in the sales page is you should get an idea from the overview page. What I left off at 57% gross profit margins. So if I build my new cars today, I'm going to have to try to get to that number or better. So here I'm not really doing better, so I'm falling behind. So it tells me that I need more operational cost reductions. If I can't beat my Okay, so here I'm able to beat it. And again, I'm just throwing these numbers really quickly in, but if you do make a vehicle that doesn't really meet or exceed all the customers' expectations, then you may want to take your sales forecast down a bit. It's always going to go up. Every round, you're going to sell more cars every round because that's how the market is just growing so fast. But if you can't necessarily get to higher, you can't get the higher characteristics for your car, then you're going to have to, look at the fact that maybe you're going to be selling less cars until you can get your operational investments at a high enough point where you could start making better profit margins. Okay. Okay, so marketing, I'm going to do offline because it takes a long time. Okay, I'm back and we're in production. So for production, again, I'm going to have to buy some more plants, it looks like. And this is going to, actually, I don't need a new one here. This is going to lower, I need a new one here. It's going to lower my total asset turnover because buying these new plants are expensive. And I had a lot of unused inventory. So that will actually help boost my my total asset turnovers because now I'm going to consume that inventory because I don't have to produce as much. Remember your excess shortage, you always want that to be lower. And I'm going to really enhance my operational investments a great deal this round because I'm falling behind in my cost reductions, which is causing me to not have as high as profit margins as I'd like. So I'm going to put some more money into that, and then going to look at see how my surplus is doing first. So I go very to the bottom of the finance page, and my surplus is 99 million. So I can I'm going to pay off some of I'm going to retire some debt. Let's see. There are limits to how much. Okay, so I'm going to retire some stock. It will help raise my earnings per share. I'm going to retire some other additional funds, long-term, short-term debt, which will lower my interest rates. And I still have a significant cash surplus. So this round, I'm very confident I'm not going to have a deficit. So let me process the round. And I'm thinking okay, 400 points. So what happened here? My profit margin went up, but my operational profit margin went a little bit lower because I was a little bit more aggressive with my advertising, and that also affected my net, and my total asset turnover did go up because I sold all that unsold inventory. So when you have a lot of unsold inventory, the round you have it, your total asset turnover will probably be lower. But when you sell the inventory, that will help. Although I did have a surplus, and I did forecast pretty well on my cars. I may have, let's see, I'm going to check my forecasts on my performance charts. And it looks like I did very well, except truck, I could have sold 400 more, and sedans, I could have sold 600 more. Okay, so my forecast wasn't perfect, but then again, I did that in like seconds. So back to the overview. So 400 points, that's really good for round 5. Completing round 4 and going into round 5 to make 400 points is fantastic because the competition is getting tougher. Let's see. Okay. All right. So I'm going to end this video here, and hopefully I try to incorporate a lot of questions that people ask me in emails during the week. I try to incorporate in these videos to make it fair for everybody, and I try to still give as many hints and encouragement to people to keep moving forward. And the truth is, if you're behind, the nice thing about this simulation is very forgiving. Even if you're behind and you're really not, you can rocket up to a higher placement. After 2 rounds, you can be in the top third of the class again very easily with points in your statistics, just as long as you don't give up and you put the effort in that's needed. This simulation is really, after working 15 years at 4 or 5 different businesses, manufacturing businesses in Long Island, I have to say that this simulation is very close to the key decision points we were making in our products, whether it's electronics, vitamins, defense company type of products. Everything I find in this simulation is very similar to what I find in the real world. So this is great training for when you become executives and get your jobs after graduation. This does give you a good basis of how sales interacts with marketing, and marketing interacts with operations, and sales interacts with operations. So basically, sales and research development kind of make a product. Then marketing spends money to manufacture it, not to manufacture, to generate demand. Then production needs to know the ideas from sales and marketing, needs a forecast so they could start gearing up their factories and their production to meet the sales projections of the sales department based on how much is their marketing and what type of product they made. And finance runs it all. The finance department has to make sure there's enough oil or money in the company's engine to lubricate, to make sure they can afford all this marketing. They can afford all these operational investments in new plants so they can make the cars and sell the cars and make a profit. So finance really is the key to make sure to keep the company on track. Because if these people didn't talk, imagine what would happen. The sales department would make a car that had the highest amount of features and probably the lowest profit margin possible because they're looking to make a great product. Marketing doesn't care. You're giving marketing a product that beats most other companies. They'll spend as much money as possible so they look good as saying, we created all this demand. Production will try, and if they have no inputs from sales, they don't know how much to make. It could be a disaster. They could make far less than they really needed. And then finance, if finance doesn't have the inputs from what sales and marketing is doing, they may not, find enough capital to run the company. So this is why this integrated project is so critical for a strategy class. So you understand how the communication between departments is vital and how a strategy has to be on the same page of all the departments so that way they can produce a company that's going to maximize shareholders' wealth. With that being said, that's my 30 minutes or less review video for round 3, and good luck in the next round. Thank you.